Well. The CPI inflation numbers came in exactly like I expected, which that means they came in hot. I have receipts from the last couple of days indicating that I felt that either CPI headline or core would surprise to the upside. Little did I know that both of them would surprise to the upside. At the headline, neither of these numbers, actually all four numbers, are good. I will tell you there is a little bit of, I don't know if you want to call it a silver lining. We'll talk about that in a minute. So let's get into inflation 2.0 right from the jump. So again, remember, when we get inflation readings, we actually get four important numbers. We get headline and core. Then we get, for each metric, we get a year-on-year number and we get a month-on-month number. And unfortunately, for this CPI reading, all four numbers, all four, were higher than expected. Headline, what you and I pay every day, food, oil, energy, all of that included, went up. It went up. It was expected to go down. Not only did it go up, but now it is up 4 months in a row. 4 months in a row. So it is up to 3.0%. Probably the biggest surprise and why it actually went up, and this is what I was saying yesterday in a video that I did with Taylor, is that the month-on-month number, this hopium that the Fed had, that the base effect would help them. Remember, we've been educating you on the base effect for a while now. That is a big number rolling off, hoping a smaller number would be added, making the number look smaller. Very simple to think about. And I warned that I feared that the market was set up for a nasty surprise. And they were. The expectation for the month number was 0.3. Actually came in at a eye-popping 0.5. That is a very big move for 1 month. So again, expected to be 2.9, came in at 3. Expected headline to be 0.3 month on month, came in at 0.5. All bad, all bad. Okay, let's go to core. Core, again, had been flat for a while at 3.2. This was supposed to be the month. This month was supposed to be the month that core finally cracked. And it stopped going at 3.2. Was supposed to go to 3.1. Well, good news, bad news. I guess the good news is it's not 3.2. Well, I don't know. Is that bad news? Probably bad news. But it's now 3.3. And again, core month on month was expected to go up 0.3. And of course, it went up 0.4. So all of these CPI numbers are bad. Bad. Okay. I'll have more about inflation in a minute, but let's give you the silver lining. The reason I called for this number to be bad is because I'm a student of history. One of the things that I think the analysts missed and got wrong, and we got right, was they forgot that this was January. Seriously, folks, they forgot it was January. What do I mean by that? Well, December for a lot of folks is the end of the year, and January, obviously, is the start of the year. So what you likely had is you had a lot of adjustments to prices, right? Let's go start a new year, blah, blah, blah. It's all of those things. And, oh, by the way, again, something I have learned and the experts missed is January inflation for 2023 and 2024 both surprised to the upside. So when I looked at the history and I looked at all the experts expecting it to come down because they were enamored with the base effect, I'm like, guys, you're missing it. It's right in front of you. And, we got another one right? So if you were on this channel, you were not surprised by this inflation reading. You were expecting at least one of these to surprise to the upside. And folks, we got both of them. So again, if we dig a little deeper inside CPI, there is, again, still some mathematical oddities, stuff that we have been talking about for a year. The first one being shelter. We've talked about shelter being made up of 30% of headline inflation. I think it's 34%, something like that. Shelter inflation is still coming in at a very hot reading of 0.4. Annualized, that's almost 5%. Folks, there's no chance in heck rents are going up 5%. It's just a structural malfeasance that is still counted that way. And again, it is what it is. It's wrong, it's stupid, it's inaccurate, but it's there. And again, you got to remember, when you have the largest contributor going up roughly 5% and it makes up 30%, most of the hot headline number was shelter. If you back out shelter and make it 0, again, we've done the math for you many months. I didn't do the math this morning, but I'll do it quickly in my head. You get an inflation reading of, I think, 2.1 if I do the math quickly. So again, much closer to the Fed's target. What you are seeing is likely a rise in core goods, which means like autos and used cars and things of that nature. So again, there's a lot of things going on in this number. I think the headline number is absolutely going to destroy the 10-year note. The 10-year note rate is going to go up. The value is going to go down. The odds of Fed rate cuts are going to collapse, and I have some details on that in a minute. I do want to remind you of my calls from Q4. One, no cuts in 25. I believe I was the first person to call that. As you'll see in a minute, more and more experts are agreeing with me. I also called mortgage rates to average 7%. We did have one day last week where they came in at 6.99, but so far every day other than that is above 7. And again, existing home sales to be less than 4 million. I think we're going to start to see January numbers here soon, and hopefully we will be right. Again, what I hope you take from this is, folks, this is playing out exactly how I've shared with you. This is the last hard year. This is an amazing year for real estate investors. We get to comb through the rubble and find the motivated sellers. You remember the story? I think it was Owe and Ann. They bought a $450,000 triplex for $242, something like that. That's the kind of stuff we could do. That's the kind of stuff investors could do in this environment. If you're patient, if you write lots of offers, if you follow up, if you just do the work. That's just where we are in this cycle. So hopefully you're listening. Hopefully you're doing the work. Hopefully you believe in yourself. And I look forward to many, many more people getting amazing deals in this environment. So what's going on with 2025 rate cuts? I got this off of X or Twitter from the Wall Street Journal analyst. I'm blanking on his name at the moment. He is saying that as of right now, Bank of America, RBC, S&P Global, BNPP, and Numera all, so what is that? 1, 2, 3, 5 banks. 5 banks are saying no cuts in 2025. Again, I want to remind you all who was the first to do that. Yours truly. The thing that's interesting about this is what I see coming. And this is what I've shared with you, I think is coming. So let's just do it one more time. Eventually, banks are going to realize that rate cuts aren't coming. Once they realize that, then they have to look at their balance sheet. And a lot of banks' balance sheets are full of trash. It's full of trash that they have been extending and pretending, hoping for lower rates to increase the value so their losses are minimized. If we go through 2025 and have no rate cuts, this extend and pretend will blow up spectacularly because the values won't increase with lower rates. They will actually, the values will decrease because not only are cap rates going to stay high, but the quality of the asset will fall apart. Again, I say this as someone who did this exact thing a decade ago. If you are an owner of an apartment building and you are holding on for dear life, you have stopped capital investment, you have stopped maintenance requests, you have stopped quality control of tenants. You are doing anything you can to get occupancy and profit to the bottom line. And that only thing that does is it takes that nice building and eventually becomes a slumlord property. This is all happening right now, and the banks are missing it. Eventually they'll see it. Eventually they'll foreclose. Eventually they'll take the losses, and we will go hunting for great deals. I do want to highlight that this is likely also happening in the private equity space. I was reading some posts today about a lot of people that having seed rounds, A rounds, B rounds, and a lot of money has been invested in these unicorns, and a lot of them are blowing up because rates aren't falling. Folks, here's the deal. We did lots of bad, stupid deals in 22, 23. Our system needs to clear out those bad deals. A lot of people today are holding on with their fingernails, hoping to be bailed out by the Fed. It's not coming. It's simply not coming. 2025 will be a hard year. It will force people to have losses. We will likely see somewhere between 100 and 400 banks forced to merge because they were overly invested in a single asset in a single area. So again, all things I've told you are coming. All things seem to be playing out as we have been discussing. The Fed Watch tool, wow, after the CPI reading had a massive change. Right, you got to remember, I think it was 3 or 4 weeks ago, we had people like Christopher Waller, Fed President Christopher Waller, talking about a March rate cut. Remember that nonsense? That's crazy. As of yesterday, or maybe it was Monday when I talked to Taylor, the odds for a March rate cut were single digits, 9%. They've got to be vanished today. In fact, as of right now, the Fed Watch tool has one rate cut in 2025, and it is October. Interesting point I saw in the Fed Watch tool is the next rate cut is December of 26. Folks, can you say higher for longer? This is just where we are at today. I do want to shout out two folks for joining school. We've got Andrew and Aaron. Both have joined our school community. Folks, if you want to be in and surrounded by a community of real estate investors, go-givers, going the same direction, 6 accountability groups, you should be joining school. It's priced at a silly 67 pennies a day. Go to school, SKOOL. Look up One Rental at a Time. Join school today. Get in the mix. Get around other people that are doing the work so you can be encouraged. You can ask questions. It is the spot to be. To me, this is very much like Bigger Pockets 1.0 decades ago when Josh Dorkin was running it in his basement. Go join school. Check out One Rental at a Time. And hey, if you don't like it, quit. It only costs you $20. I do have a lot of Fed speak that I captured yesterday before this CPI reading, so we'll talk about it quickly. Powell is out again reiterating that there is in a no rush to cut rates. You know what? I haven't said this before, but it just jumped in my head. There's a chance that Jerome Powell doesn't cut rates the rest of his term. I believe his term is 15 or 16 months left. I think it's April of 26, something like that. Maybe May. I think it's April. So there's a chance that Jerome Powell doesn't cut anymore. It's flat. Now, I'm sticking with my no cuts in 25, but again, there's a chance that there's no cuts until he's out. So that'll be interesting. Powell also highlighted housing. He said, once we lower rates and mortgage rates fall, we are still going to have a housing shortage. Basically, he's saying, folks, stop looking at the Fed to fix housing. It's not my problem. It's not my problem. You need to build more. You need to build the right stuff. We need to have a national emergency to build entry-level housing, 990 square feet, 1,050. We need to go back and revisit what we did in the 50s and 70s and just build communities of affordable entry-level housing. That is like freaking unicorns on rainbows right now. We don't have that stuff in inventory. Powell, last comment I have before I switch to Williams, Fed President Williams. The U.S. will not have a central bank digital currency while I am Fed chair. I think that is a pretty clear thing saying, stop asking me these questions. It's not coming. What did Fed President Williams have to say the other day? He said, again, you got to remember this was yesterday, so I don't know if he would still say these things, but here we go. Monetary policy is at an appropriate level. Monetary policy is appropriately restrictive. Interesting. The U.S. economy will grow at 2% this year. Inflation will be 2.5%. Ouch, Williams. You might want to revisit that one. And it will be 2% next year. Maybe. And then Fed President Williams expects unemployment to range between 4 and 4.25. Lastly, overall numbers of the economy are very, very good. He did say that twice. Very, very good. No, and it's not obvious that lower rates will lower housing inflation. Folks, it won't. We've had this discussion for a while. If you take rates from 7 to 5.5, things get bananas. It gets wild. So we just need higher for longer to kind of work through this process. Last thing we'll talk about, it looks like mortgage applications were actually up, but again, I think it's a structural oddity. Mortgage applications, again, if you look at the macro, are up 2.3%. Refi demand up 10%, 33% year on year. More on that in a second. Purchase demand down 2%. I think I've said this before, but I do want to say it again. I think the fact that refinances are up 10% when rates are 7% and up 33% year on year is a red flag. I think this means there's lots of people hurting, and they are digging into their houses as ATM machines again. Again, there are other things you could do. You can get equity lines. You can get seconds. Again, I have no facts to base this on other than human nature and the greed of call centers. I suspect somewhere between 30 and 40% of the refis done today are actually detrimental to the home buyer, meaning they have taken their lifetime best asset, a 2.3% mortgage, and they've cashed out a couple of bucks, and now it's all 7% money. And I think that's a shame. We need more education, financial education. We need no options. The last thing about mortgage, I will say, highlighted from Lance Lambert, Resi Club, mortgage rates as of yesterday were 7.05%. They're going higher today, believe me. But last year, 52 weeks ago, they were 6.98. Why is that important? Because I think this is leading us to a point where a lot more consumers give up and they accept 7. Remember, I've said for a long time, 7 good, 6 bad. The longer we stay at 7, the better 7 looks. Consumers have recency bias. They are short-term oriented. So again, this is all playing out exactly how I expected. 2025 will be the last hard year for real estate. 2025 will be an amazing year for real estate investors because, again, we don't have to buy. We can search for motivated sellers. We can buy triplexes that were once priced at $450 for $242. Folks, do the work. We're a couple of days from Vegas. I think today, guys, I don't know if you know this, but today, guys, is Midnight Madness at Denny's. The guys, Matt, Mike, Dion, and many others will be at Denny's in Vegas for Midnight Madness. And I look forward to the stories. Guys, take care of yourself. Have an amazing day. Like, subscribe, comment. Later.